Our next guest isn't convinced that the Fed's emergency rate cut will do much to counteract effects of the coronavirus on markets. And joining us is Louis Lau, director at Brands Investment Partners. So, Louis, this is the first emergency rate cut since the financial crisis. You've heard us kind of going through the day here. For you, as a long-term investor, when you see a day like this after yesterday, are you seeing value in this market right now worth stepping in for?
Yeah, I think if you look at the world globally, the U.S. has started from a very high level in terms of valuation. So I think going into the coronavirus, the U.S. is one of the most expensive markets compared to Europe, Japan, and certainly compared to emerging markets. So I think what you're seeing is a virus come out of nowhere and hitting a very expensive market that was already on a slowing trajectory. So I think the reaction from the market in terms of not coming back after the rate cut is not a surprise to us.
And then, Louis, in an environment like this, is there any way, I mean, you look at what companies have been saying about, pulling their guidance, cutting their guidance, altering their guidance. Is there any way to get a fundamental picture of how coronavirus might be impacting corporate America? Or is it just going to take time to see what companies do and don't say before you can start to really build a case for earnings growth, let alone for the market, just for certain individual companies you might be looking at?
Yeah, that's a great question. I think when we look at, trying to assess earnings, remember the coronavirus really broke out at the end of January. So we've not even seen a full quarter being reported. And for some of the manufacturing businesses that are dependent on inputs from China, we haven't really seen the impact of supply chain disruptions on China, from China, affecting the U.S. I think that's one. The other thing is that the U.S. being a service sector economy where most of the the economic activity is dominated by services, is going to do a lot better than manufacturing economies because a lot of things can be communicated over technology. There's a lot of remote working capabilities, and so I think a lot of the service sector activity can still go on, aided by technology, as opposed to manufacturing economies where you saw countries like South Korea and Thailand get bigger, more affected by the coronavirus than here in the U.S.
Jared Blicker here. I'm wondering if you're taking any of the market signals. We've seen a lot of volatility in the stock market, but the 10-year yield has been dropping like a stone. The dollar has been dropping like a stone versus several currencies, not the least of which is the euro. Any trends there that factor into your macro analysis?
Yeah, I think there's going to come a point where the interest rate environment is not going to help the fundamental valuation for companies because I think what we're seeing is in the stock market that even if the interest rates were to go lower, that doesn't necessarily help stock valuations if they're starting from a very high point. I think one of the interesting sectors that is getting hit that we think has a lot of value right now is financials. So if you look at financials in countries in Asia like Thailand, South Korea that have been really hit because people are afraid that, the rate cuts will affect the margins, economic growth will be slower. I think that's where the value is in some of these areas that have been hit very hard, by some of these interest rate declines.
Louis Lau is Director of Investments at Brands Investment Partners. Thanks so much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.